Hi there. Pilot trusts remain relevant in specific estate planning situations. Learn how they are currently used and where professional advice matters. Hi there.
A simple £10 note pinned to a legal deed can still shield millions of pounds from UK inheritance tax. Handled correctly, this structure can save estates nearly £100,000 in periodic charges. Many professional advisors believe the 2015 tax reforms closed this route entirely. They assume pilot trusts are a relic of the past. But smart UK entrepreneurs are still actively exploiting specific legal exemptions today. I am a senior tax expert at Pro Tax Accountant. We specialize in navigating the complex realities of high net worth tax strategies. Today, we are breaking down exactly how pilot trusts function under the 2026 tax framework, using a real-world, high-stakes case study. Relying on outdated advice about these structures guarantees the unnecessary erosion of family wealth to HMRC. Consider James. He is a 62-year-old UK entrepreneur facing a potential inheritance tax liability of £2 million. His advisor recommends purchasing a £2 million whole-of-life insurance policy. This guarantees his family will have the liquid cash required to pay the eventual death duties. However, placing this policy into a standard single discretionary trust subjects it to the relevant property regime. Under this regime, the trust undergoes a mandatory tax review every 10 years. The current tax-free threshold, known as the nil rate band for a trust, is £325,000. Any accumulated value exceeding this limit faces heavy taxation. Buying life insurance solves the liquidity problem, but if placed in the wrong legal wrapper, the insurance policy itself becomes a massive independent tax liability. This table projects placing James's policy into a single trust. In the non-write-off column, premiums accumulate, exceeding the £325,000 allowance. By year 30, total premiums breach £1.2 million, triggering massive periodic charges. Altogether, the estate bleeds over £93,500. Furthermore, a depleted trust allowance triggers a proportionate exit charge when James eventually dies and the insurance funds are distributed to his heirs. The standard single trust model is mathematically broken for high-premium whole-of-life policies. A structural redesign is required. We deploy RISAF planning. Instead of one trust, James creates 8 separate pilot trusts seeded with just £10. The £2 million policy is split into 8 £250,000 blocks. The critical step, they must be established on 8 consecutive separate days. Because these trusts are created on different dates, legal precedent dictates HMRC must treat them as completely unrelated settlements. As a result, each of the 8 trusts receives its own entirely separate £325,000 nil rate band. Returning to the projection data, the right-hand column shows the RISAF planning outcome. Divided across 8 independent allowances, the premiums never breach the individual thresholds at the 10, 20, or 30-year review points. The periodic charges remain zero. Temporal separation, the simple act of spacing out signatures, is the legal mechanism that multiplies a taxpayer's tax-free threshold. This brings us to the same-day addition rule, or SDAR. Introduced in 2015, this legislation was designed specifically to halt pilot trust proliferation. The rule aggregates all assets added to multiple trusts on the same day. Because estate distributions are deemed to occur on the date of death, the SDAR effectively destroys will-based pilot trust planning. However, regular life insurance premiums are explicitly exempt. Paying them does not constitute a transfer of value, allowing the RISAF structure to bypass the SDAR aggregation entirely. Similarly, pension death benefits paid into a spousal bypass pilot trust escape the SDAR net, as they are paid at the discretion of scheme administrators. But the legislative window is shifting. In April 2027, unspent pension pots will be pulled back into the inheritance tax net, requiring immediate professional review. Pilot trusts are no longer a blanket solution for estate planning. They are highly specialized tools that function properly only when paired with immune asset classes, like pure protection policies. The cost of this tax efficiency is absolute and unforgiving administrative compliance. Under the 2026 Trust Registration Service Rules, a de minimis exemption forgives the registration requirement for low-risk trusts holding under £10,000. But there is a trap in the legislation. This exemption is strictly limited to one trust per settler. Because James established 8 parallel trusts, he immediately breaches this limit. He must register every single trust with HMRC within a strict 90-day window or face fixed statutory penalties. A secondary trap exists in the updated income tax rules. The historical £1,000 standard rate band has been abolished, replaced by a rigid £500 allowance. If a trust generates even £501 in income, the exemption vanishes and the entire amount is taxed at the maximum 45% rate. HMRC has traded loophole closures for compliance tripwires. The trusts still work perfectly, but only if managed flawlessly by tax professionals. Let us review James's final outcome. Over his lifetime, £1.26 million in premiums are paid into the trusts, establishing a protective fund that bypasses probate delays entirely. Across the 30-year timeline, his periodic tax charges remain exactly zero. Pilot trusts in 2026 demand absolute precision. A single wrong signature date, or a missed 90-day TRS registration deadline, will unravel the entire £93,000 tax saving. If you are a UK entrepreneur or high net worth individual requiring this level of structural precision, contact Pro Tax Accountant using the details on screen. Hit the subscribe button for more high-level breakdowns of UK tax strategy. Please remember that tax rules are highly individual and subject to constant legislative change. This video is for educational purposes, and you should always seek personalized professional advice. Proper trust structuring is the ultimate difference between leaving a lasting family legacy and making a massive voluntary donation to HMRC.